From a macro perspective, financial services is like 20% of global GDP.
Really?
It's really like money. It's like ones and zeros. So it should inherently be digital. And then from a micro perspective, it's actually not as digital as I want it to be. I recently signed up for a new credit card and they asked me to fax a form. It just feels like even in 2024, this kind of shit is happening. There's a huge opportunity to build companies that make life easier for people.
I think I saw this stat, 1% of financial services revenue is from kind of like technology, fintech companies or something like that.
Yeah, so there's a huge opportunity in making that 1% 10%.
Hopefully 100% soon. Like no more faxes.
Yeah, exactly. So I think that's what got us excited about fintech.
Welcome to The Peel. I'm your host, Turner Novak, founder of Banana Capital. Today's guest is Sheel Mohnot, co-founder of multiple fintech companies, and most recently, Better Tomorrow Ventures, an early-stage fintech-focused fund leading pre-seed and seed rounds.
We think that financial services disproportionately has the ability to impact people's lives and make them better.
Our conversation weaves through Sheel's 2 decades of building and investing in fintech, starting BTV, and why they built a fintech-focused accelerator, the Mint.
The vast majority of them were not looking for an accelerator. They were looking for early-stage funding and liked the idea of working with people who had been founders before, run successful companies, and are specialists in fintech. One of our companies in this most recent cohort, they were having trouble getting a bank partnership. And then after working with us, a bank said, yeah, if you're a BTV company, we will work with you. That was a huge unlock that it's possible they wouldn't have been able to get it at all if they weren't working with us.
Fun facts on Sheel: he was a contestant on the Zoom Bachelor during COVID lockdowns, in a Justin Bieber music video, got married in the Taco Bell Metaverse, and was once banned from Uber.
I had over $10,000 in credit in my account, and it was just sitting there.
We talk lessons competing against Stripe before selling his first company, common fintech startup pitfalls, and the trick every VC should use when fundraising.
And I do this all the time for folks that we've co-invested with. If they're meeting with one of our LPs, I will...
Before we talk to Sheel, I publish 2 episodes of The Peel every week, exploring the world's greatest startup stories. Check the show notes to go deeper on each topic, comment on Spotify and YouTube, explore the back catalog, share this with a friend starting a fintech company, and subscribe wherever you're listening so you never miss an episode. Let's talk to Sheel.
Sheel, welcome to the show.
Glad to be here.
Yeah, I'm glad you're here too. I know we were talking a little bit. I'm kind of sick right now, so I'm going to try to not talk as much as possible. And it's going to be only you for the next 2 hours.
Should I just interview myself?
Or we'll use the AI stuff. We'll swap with an AI, make my voice.
I like that. Yeah.
Well, so really quick for people who don't know, what is BTV, Better Tomorrow Ventures?
Yeah, BTV is a pre-seed and seed stage fund investing in fintech companies and leading rounds. And when I say fintech, I want to be clear that we take a pretty broad view on fintech. So there's a lot of companies that other people don't necessarily think about as fintech that we do. As an example, like vertical SaaS, we think most vertical SaaS companies ultimately will get a lot of their revenue from fintech. And actually, if you look at our first ever pitch deck, we talked about that, and we talked about Toast and Shopify. Now, Toast and Shopify are public companies, so we have the data, and over 80% of the revenue today is financial services. So they have become fintech companies. We also think B2B marketplaces have a lot of fintech tendencies, so we invest in those kind of companies too. But generally, we take a broad view on fintech, and that's what we invest in. And like I said, leading pre-seed and seed rounds.
Okay, and so why fintech specifically? You you should have pivoted to crypto, Web3, AI. Why is fintech interesting?
I'd say we just love this stuff. Myself and Jake, the other GP. I think it starts from our backgrounds. If you connect the dots backwards, so to speak, we just happened to start fintech companies around the same time. And then it was really early in the world of fintech even being a word. And then we just really liked it. And then when it came time to decide a space to invest in, for me, this was 2015, 2016. I just looked around. I built two companies that were fintech in the world of fintech, and I was just thinking about where is there a huge opportunity. And from a macro perspective, financial services is like 20% of global GDP.
Really?
And it's really like money. It's like ones and zeros. So it should inherently be digital. And then from a micro perspective, it's actually not as digital as I want it to be. Like I recently signed up for a new credit card and they asked me to fax a form in 2024. Like they asked me to fax, sign wet ink and mail or fax it to them. And there was one other hiccup I had and they were like, come into a branch. And so it just feels like even in 2024, this kind of shit is happening. There's a huge opportunity to build companies that make life easier for people.
And I think I saw this stat, like 1% of financial services revenue is from kind of like technology, fintech companies or something like that.
Yeah. So there's a huge opportunity in, making that 1%, 10%.
Hopefully 100% soon. Like no more faxes.
Yeah, exactly. So I think that's what got us excited about fintech. And the reason it's called Better Tomorrow is actually we think that financial services disproportionately has the ability to impact people's lives and make them better. So we want to improve people's lives, make them better tomorrow. And then the other reason is we want to improve ourselves. So there's constantly things that I wish I did better, like something I did bad yesterday. I could have done a better job and I want to do a better job tomorrow.
Wow, that's great marketing, I guess, positioning.
Naming is hard, We don't all have like a brilliant name like Banana Capital off the top of our head that is an emoji too.
Yeah, fair. Do you guys have an emoji for Better Tomorrow?
We don't have an emoji. We have actually you can see it behind me. We have this like our logo is a mountain or a sunrise over a mountain. You can actually see it on my shirt too.
Oh yeah, okay. That's pretty slick, yeah.
It's cryptic. Who knows? Nobody probably knows that that's what it is, but that's what when we created the logo, that's what we had in mind.
Well, better than calling it like Sunrise Capital or like Mountain Ventures or something. Like that's, yeah, at least you guys went a little further, making it a little bit more
further.
creative.
Yeah.
Are there any areas in fintech that you think are like the most interesting right now? Like if you're thinking like, okay, it's the 2024, 2025, we want to be deploying capital or trying to build things, like any areas maybe you're thinking about, you've invested in recently, or you think there might be something that's kind of coming up?
Yeah, I mean, I think it's actually a lot of the same stuff we've been investing in. I don't have any like requests for startups at the moment.
You don't like sit with a crystal ball and like make proclamations into the void?
No, I'm not Chamath saying that Visa and MasterCard are going bankrupt or whatever. I think a lot of the traditional fintech opportunities are still there. So one that we believe in strongly is embedded fintech. So we think a lot of the SMB software is like Toast and Shopify will ultimately be driven by financial services. And we want to invest in companies that help get them there. So we've invested in companies like Unip, that's banking as a service, Salsa, that's payroll as a service, and Layer, that's accounting as a service, all three of which sell into Toast and Toast-like companies. That's one thesis. Another broad thesis we have is the world of accounting. So there's an accountant shortage in this country. The stats are pretty crazy, but basically a lot of universities, since the time that I graduated college, there's been a steady decline in universities being offering the major. Nobody wants to study accounting anymore. I think in part, it just became like a very uncool thing to study.
And it sucks too. Did you take any accounting classes in college?
I did. And it sucks, but it's actually important. Like it's important in my world today. I think like understanding the nuances of an income statement and balance sheet and like quality of revenue, some of that's like strategic finance, but all of that accounting stuff is actually pretty useful, but nobody wants to learn that stuff anymore, it feels like. So there's this shortage of accountants, and so like the average age of an accountant has crept up and up, and so they're all retiring in the coming like 5 to 10 years, and so the shortage that exists today is actually going to get a lot worse. And we think it's the perfect opportunity for technology to step in and solve that problem. So like we identified this problem a couple of years ago. We've invested in 3 companies behind this thesis and actually might do more. So the companies we've invested in are Layer, which we talked about, which is accounting as a service. So they sell into vertical SaaS companies. So imagine you're Toast, you're a restaurant owner that uses Toast. A lot of the work that you need, a lot of the data that you need to do your accounting is actually already embedded in that vertical software.
In the sales system. Like that is all the...
It's a lot of the information needed. It's kind of like your vertical ERP. You have like your customer data, like when they swipe, it's all there. You have your employees when they come into work, like how much you pay them. It's all in that system already. And so rather than exporting that data from that system to another system and then manually doing work, like Layer automates that process and does it for you. And ultimately will be replacing that entry-level bookkeeper by doing that work.
So maybe basic question.
Yeah.
Why doesn't Toast just make the accounting stuff themselves? Like, that seems pretty straightforward, right?
Yeah, it's a great question. So Toast might be at a scale where they could theoretically do something like that on their own, but accounting is not trivial to build. Like if you think about it, you're building an entirely new product, QuickBooks, and then some. And it's not like that's a really easy product to build. It's a very complicated product to build. Toast has kind of learned their lesson, and to build payroll, they actually acquired a company to do so. And then I believe it took them actually 2 years post acquiring that company to integrate it in. So I think they realize these products are not trivial to build, even if you buy a company, and it's better to work with a company and integrate in. And so they already are partnering with our portfolio companies. So and actually one interesting thing is the founder of Layer, or one of the founders, Justin, actually came from Square, and the idea for this business came while he was at Square wanting to build this and then looking for a solution that existed outside, realizing there wasn't a solution where he could use an embedded solution. And then he decided to leave Square and build it.
Interesting. So another question then, there's probably a lot of people listening to this that are in a similar position, working somewhere, find a problem, and they think, oh, I'm going to start a fintech company. Is there anything that you see people get wrong when they're kind of new to fintech or they've never started a company before? Like common pitfalls where you see, they were like lending in the wrong way, compliant or something. Like, are there any pitfalls, like common traps?
Well, yeah, I mean, compliance is super important and is a superpower if used correctly, especially if you're building something embedded for somebody else. Like that other party really wants to make sure, like they want to integrate your product, but and they want to test it out, but they really don't want to get in trouble for doing so. So I think like starting with great compliance is really important. I think a lot of first timers in fintech really get timelines wrong. Like it always takes a lot longer to get started than you think. And every integration, especially with the bank, just takes so much longer. Like you might, a first time fintech founder might say like, oh yeah, like I had this great conversation with the bank. They think we can get started and launch in 3 months. And then like 9 months later, they're like, yeah, we're going to be live in 3 months. And then, like, it's still
another 9 months later.
So I think people have been around the block a little bit, or have investors or mentors who have been around the block a bit, can be more realistic on timeline and can actually shortcut that stuff. I think that's one of the things where we can be super helpful as an investor, and why you might want to take money from at seed or pre-seed from somebody who's done it before is like for example, on the bank piece, it's gotten a lot harder to get a bank partnership than it was a few years ago for a variety of reasons, regulatory and otherwise. But there are a lot of banks who work with a bunch of our portfolio companies already. And while they're not adding net new partnerships, they are willing to add partnerships through us because we're a trusted party that already works with them. And so we can shortcut that timeline a little bit. Like if you went and approached them, they might say, it's not going to happen until the second half of 2025. But if we went and said, hey, like you're already working with 3 of our other portfolio companies, like we have a great relationship. Could you sneak these guys in February? And they might be willing to do so.
Interesting. And you guys have a lot of, maybe not a lot, but some of your investors in BTV are actually other financial services companies like banks, insurance, et cetera, stuff like that.
Yeah, we do have some. We don't have a whole lot of strategic investors, but we have a couple of insurance companies and a bank that have invested in BTV, and they have been great partners to our portfolio.
Thinking about just fintech stuff, you've been doing it for a long time. You mentioned you've built a couple companies. I thought it'd be interesting because we've actually never talked about this before, like some of the companies that you've built in fintech. So going back to the very first one, it was called Fee Fighters. How did that come about and what was it?
So it was really my friend Sean Harper, who's now the CEO of Kin, which is an awesome homeowners insurance company, like super successful business, hundreds of millions of revenue. He and I worked together at BCG, the consulting firm, and he was leaving to start this company. He had previously started a satellite radio company that sold like hardware for satellite radios, like XM and Sirius at the time.
Was this like early 2000s?
Yeah, it was like 2006, 7, probably 8, 9.
So this was like heyday because smartphones weren't really a thing.
That's right. And so he built that company and then realized that he'd been getting ripped off on credit card processing. So,
oh, interesting. Oh, selling them
which a lot of people do get ripped off on credit card processing.
Really? How do you get ripped off?
If you wanted to accept credit cards on your website, you would like go to your local bank, or there's something called an ISO, independent sales organization, where everybody has like some random cousin who sells credit card processing.
Wait, still? Or this was back in the day?
Even now, a lot of people do. And so like if you're like a restaurant, and now it's different because of Toast. So like Stripe and others like Stripe really have made it a lot easier in the past decade, but I'm talking 15 years ago. And so you would just like go to your local bank or go to one of these independent sales organizations or talk to people and be like, who do you use for credit card processing? And then you'd get this deal, and the deal you got, it would claim a particular price and you'd be like, oh yeah, this is what I'm paying. And then actually there'd be all these bullshit fees. So you end up paying a lot more. And the margins that these independent sales agents made were astronomical, and they would increase your fees every year. And it was kind of bullshit.
So what percentage of revenue would you pay in credit card processing fees? Like if you sold something for $100?
We saw people who were paying like 7% on credit card processing, and they thought they were paying 3%.
How does that happen?
Because like there are all these additional, like they have this number in their head of like what they're paying, and they just make their assumptions based off of that. And then like you get the monthly update, and it's so hard to read, and there's so many embedded fees in there that like you would think it'd be simple. Like you see the amount that you collect and you like put that against what you thought you should collect. But a lot of people did not do that math. And then people also thought that people didn't realize it was something that you could negotiate. People just thought like, I pay when I pay, that's Visa and MasterCard. But actually there are a bunch of middlemen in the way that make, in some cases, most of the money. So we set out to build a company that made it easier and cheaper to accept credit cards. So V1 of Fee Fighters was a marketplace for credit card payments. So you come give us a few pieces of information about your business, and then the processors bid down for your business. And so you end up paying a really low fee, and like the margins get super compressed.
Okay, so this is instead of like me going to a broker who's just like, oh, yep, we're going with this. This is the person we're doing. You insert competition, which drives down prices.
Drives down prices, and prices went down very significantly. So I think the average margin that people were making before they came to us was like 150 basis points they were losing to this fee. And with us, they were paying like 20 basis points. So it's like a major creation of like surplus for the merchant. So we started that business and it was pretty successful. But then we decided, okay, we initially thought that our customers were going to be like mom and pop merchants, like your main street, like restaurant, hotel, dentist office, that kind of thing. And then what we found out was actually a lot of our customers were like online businesses. And online businesses, they had to not only get a merchant account, which they could get from us, they also had to use something called a payment gateway, which is, so the merchant account is the flow of money and the payment gateway is the flow of data. And so you actually needed both. And so we decided, okay, let's build our own payment gateway. And so we built a payment gateway and merged the merchant account and payment gateway into one. And by the way, this is actually what Stripe is a merchant account and payment gateway in one.
So you were building Stripe without knowing what Stripe is today.
Yeah, that's right. And interestingly enough, Stripe in their early days, and they've told us this since, like John and Patrick were like reading our blog religiously, were like using our product. And so we built what we called Samurai, which was a fixed price, like basically early version of Stripe. And we'd raised only a seed round, $1.6 million. And then we started to raise a Series A, but during this time, we got an acquisition offer from Groupon. And Groupon, we were based in Chicago. Groupon at the time was this high-flying company. It's hard to think about it now as this, but like it was, considered like the fastest growing company or whatever.
Yeah, it was like the ramp or like the open AI of that time. Like I'm not saying that the same thing is going to happen to these, but like I think maybe those are slightly better businesses. I don't know. But Groupon was they'd gone public, right? Or not yet.
They'd just gone public. Like at the time we were talking to them, they'd gone public and it was like a $20 billion company. Just crazy. I think now it's like a few $100 million company. Anyway, we got this acquisition offer. They were in Chicago. We were in Chicago. We had some limitations in that Josh and Sean, the CTO and CEO, didn't want to move to California. And I think if they did, we would have had a lot more options. But they wanted to stay in Chicago. And so we had this offer from Groupon. We ended up taking the offer. And, look, in hindsight, we didn't become Stripe. Who knows if we would have anyway. It ended up being pretty good for us financially. Like, it got me into angel investing. And this is in 2012. It was a great time to be an angel investor. I started investing in companies. I wanted to help companies avoid the mistakes that I made. And it worked out well. Like I angel invested, that led to me being a full-time investor, and it's been awesome.
I think one thing you mentioned was Groupon stock price went up by they had like $600 million in market cap. Like the day it was announced or something. What is that like?
It was wild. So Groupon, it's hard to like think about an equivalent company because the equivalent company today would not be public. But like it was a super hot company that had just gone public. Everyone was following the news. Like it was on Hacker News like every day, like whatever was going on at Groupon.
Really?
So top of mind. And of course there were haters who were right. And so the day we got acquired, they announced it and the stock just like skyrocketed because so Groupon's core product was this like couponing business. And we were an entirely new business line, which was like merchant products. So building new products for merchants. So we built, so our product was a payments product. We ultimately acquired a point of sale company that was called Breadcrumb that then they spun out.
So the thinking was like they're acquiring all these merchants to try to like give deals to consumers, but they weren't really monetizing the merchants. And you were giving them an opportunity to make more money.
Exactly. So make a lot more money off of the same merchant base. And so the stock loved that. And skyrocketed in value that day, before. And then like roughly a year after we got acquired, Andrew Mason, who was the CEO, resigned, got fired in a boardroom battle. And then that was kind of the beginning of the end.
Anything that you mentioned, there's things you wish you did differently for your first startup or your first company that you wanted to help other founders avoid. Interested in that, but also what was it like, the process of getting acquired? Like anything that surprised you, just someone who's never been through an acquisition before might, like to hear before getting into a process.
Yeah, it's a lot of negotiation. Like the initial offer was total crap. And the way that they approached us, like we didn't really know originally that it was going to be an acquisition conversation.
Oh, was it related to the fundraising?
Yeah, we thought like, okay, maybe there'll be investors in our Series A. Maybe we went into it thinking like, let's just talk to them about becoming customers. And then like we had a really good conversation. We had no idea that they were going to make an acquisition offer. And then when they did, then you want to build heat on the deal. So you want to like get other potential acquirers involved. I think like we could have done a way better job of that than we did. We did do some. We spoke to, Square, Google. Square was really a young company at the time, so it didn't really make much sense for them. But we spoke to a bunch of other folks, and then ultimately the Groupon offer was better. And, look, at the end of the day, we probably could have done better financially somewhere else. But given that the other team members didn't want to leave Chicago, I think it was a great outcome.
That's fair, yeah. And you mentioned some other big mistakes that you made that you like helping people avoid. Anything that comes to mind as just biggest mistakes, just broadly building the company?
I think there's a lot more knowledge about how to build a company today than there was back then, which was like now 14 years ago, 15 years ago. It feels crazy. I think that like we didn't know content marketing. Like we had to figure out on our own, like LTV to CAC, content marketing, like what these things meant, how to quantitatively market, what we should pay to acquire a customer. We were figuring all these things out. And now I think there's a well-trodden playbook for it. And I think we did a good job at it, but I think we could have done a better job at it. Who to take on as investors, all that kind of stuff.
That makes sense. Yeah, I guess like the thinking when you tell me you were acquiring small mom and pop is customers, like generally pretty small LTV on those. And it's like, what's the math of like how cheaply and quickly do you need to acquire those to make a viable business? It has to be pretty freaking fast with customers that are that small.
Absolutely. Yeah, totally. And so that was a lesson. I think that business, like it could have, so the original business, I think was an okay business, would have been a really good non-venture backed business. And then the business we like got into when we built the payment gateway and everything obviously Stripe was an amazing business. So like would have been a great business. And like, it's easy to, I think other people in my position have like looked back and said, oh, we could have been Stripe. But like, I don't feel that way. Like I don't have, there's no regret in my mind about how things ended up.
Yeah. Well, and it feels like they're customers of developers. Like that's startups, you can do like quick adoption, but even on the enterprise side, like, and a lot of those startups became enterprises. Like I know Shopify, Uber, DoorDash, all, big customers, massive, multi-$100 billion public companies now within, 20 years. That's pretty good.
It is sort of the API game, right? Like people start building on you when they're small and they continue building on you when they're big. And then of course, like in payments, like the margin profile changes substantially. But
one interesting story related to Ryan Peterson and Flexport. You were an investor, but I know you guys did something pretty interesting. It might have been somewhere around this time with Uber referral codes. That's probably one of the craziest stories I've ever heard. What was that exactly?
Could get us in trouble, but it's been so long that it's probably fine.
I think you already got in trouble for it, didn't you?
Yeah, that's true. I did get in trouble for it. Okay. So I don't even remember exactly where I met Ryan at some party or something, but we were both doing this thing where, and it was a fun idea. you could advertise on Google AdWords for your Uber promo code. Like it was like Sheel05, enter Sheel05. And at the time, a lot of people were signing up for Uber for the first time. And you would get some amount of money in Uber credits for if they use your promo code. So I think the rough math and the amount of money you got fluctuated wildly based on like what numbers they wanted to hit in customer acquisition. But I think like for a time you would get like $50 or even $100 to if somebody signed up using $100 in Uber credit if somebody signed up using your code. And using AdWords, we were buying users of Uber for like $10 to $15. So it was a huge ROI for us to have somebody to market to use Sheel05 code, and then we'd get $100. And so we did this enough where actually I had like over $10,000 in credit in my account, and it was just sitting there. And I was like, okay, like I don't know how long this is going to last, but while it exists, I spent, $1,000 or something to get that $10,000 of value of Uber value. And then ultimately what happened was I was in India and had some payments issue. And I like unfortunately complained into Uber customer service that my account wasn't working because of some issue in India. And they looked at my account and were like, why do you have so many Uber credits? And then they looked into it and they canceled my account. So I actually had to start a new Uber account from scratch.
Oh, wow. Okay. And you just lost all the credits?
I did. I think I still netted out positively because I'd spent less than I would have, for that equivalent amount of Uber. But I think Ryan was doing the same thing and we kind of bonded over that in the early days, just being like a hacky user. You kind of learn how to use AdWords and you make some money. And he's been he's obviously a great entrepreneur. And I think some of that hackiness is really important when you start a company.
Yeah, and you did end up investing in Flexport, I think, like right around when you started the company, right?
Yeah, right when he started. Actually, I think I tried to invest before he did YC, but he didn't take any money. And then I invested, during his YC batch, and it's obviously been really good. Been awesome to watch him build that company. And I think the thesis there was global trade is a huge opportunity and very broken. If you've ever imported or exported something, like you've seen that. And I had some experience doing that. When I was much younger, I had a headphone company. And so had some experience importing goods from China. And I knew there were a lot of ways for that to be made easier with technology. And then I felt like Ryan was the right guy to do it. He'd built a previous company in imports, actually 2 previous companies in imports, and like just had the right amount of scrappiness. So it was a big idea with, I thought, an outstanding founder. And so, was happy that he went after it and was happy to be part of the journey.
Was it like kind of obvious at the time? Like I know there's like hot seed rounds, less hot YC rounds. Like what was it?
It wasn't super hot at the time. I don't think it would have been like the hottest deal in YC, but I think at the time it was a $10 million cap, which was pretty high for YC, but I don't think it was like the round you had to get in that batch.
Yeah, it feels like there's usually, I feel like the latest is it's like the different thresholds is they have 15 million, 20 and 25 million. Then maybe there's like a little bit above 25 where it's like the 25 million and above is like clear KPIs, clear traction. Everyone wants in. The 20 is like, there's a little bit of uncertainty. The founders are really good. Maybe there's something there. And then the 15 is just like YC doesn't really know how to think of this thing, but like you can't sell too much of it to like, mess up the math. So it's just like 15 million posts is what we're doing.
I think the interesting thing is like a lot of the best companies in YC over the last many years have actually been pivots of something else or something where it wasn't obvious at the beginning. We had, at the Mint, we had Christina, the CEO of Vanta. She was an awesome interview, by the way. And Vanta, which is a SOC 2 compliance software, she said like in 2018, when she started the business, she estimated the entire market for SOC 2 compliance to be $100 million. And so
they have more revenue than that today.
They have more what she estimated the entire market to be. So it was hard for her to raise money. And if you look at the investors, it's not like your who's who of investors. And then over the next few years, she built like an amazing business. I think was already profitable, and then Sequoia threw a bunch of money at her at a great price. And the business has continued to scale from there. But so that was not obvious. And then if you look at Whatnot, I think it was like a e-commerce site for Funko Pop toys. So a lot of these companies were not necessarily what they became. So it's hard to know which ones are successful at YC Demo Day.
Yeah, I remember meeting Grant. It was 5 months after he launched the live streaming, and he was kind of, I forget exactly how the conversation went, but it was basically like, we've grown 100%, over 100% a month since we launched live streaming. And I was like, that's pretty crazy. I was also super skeptical about live streaming at the time because it was like the consumer category that people couldn't shut up about. Yeah. And so I think that kind of blinded me. I have this like weird thing, if something's too hot, I kind of have like an allergic reaction to it, which is maybe good, but also I think has probably hurt me at times too. I'm trying to personally, like as an investor, I'm trying to navigate the best of both worlds of that. Because usually, like if something is too hot, there's too much excitement. Sometimes there's some cracks that people overlook, but I mean, all the greatest technologies all get super overhyped, and there's a reason. So it's like, it's hard.
It's a tough one for me. I think about this a lot too. And in fintech, especially in the crazy times of 2020 and 2021, like every single company we invested in had 4 or 5 well-funded competitors, and they were all doing roughly the same thing.
How did you like rationalize that? Like, did you think we're going to win? Did you think like there's going to be multiple winners in the space? Like, did you ever like walk away from categories because of that? Or
I walked away in a bunch of categories. And so in some cases when we invested, like we invested before we saw all the others, and then we saw others, and then who knows what we would have invested in. I think in enough of the companies, we got the winner right. Or in some cases, like it actually, in one case, we invested in a company that was kind of like petering along for a long time. And then their competition died. Like they decided not to continue it. Like our company hadn't grown revenue in like a year. And then a year ago, we actually wrote it down on our like quarterly update. We like said, this company hasn't grown revenue. Like we don't, and they had like, I think they had like 8 months of runway or something. So we were like, okay, we're going to write this company down. And then this year, 2024, they like went from like 1 million of revenue to like ending the year at like 6 million of revenue profitably. And it's in part because their competitors went away, and in part because they figured out some things on the business. So I think that's been good. But to answer your question, like there are a bunch of categories we just skipped entirely. One was like Plaid for payroll. We met a bunch of companies around the same time building that, and several of them ended up being successful. SOC 2 compliance, I actually met Vanta, not during the seed, so it was past the time that we would invest, but I met Vanta and thought this is a really good business. And then I met, Drada, ThoroPass, SecureFrame, and thought like these could be good businesses, but it's hard to know if the overall market is big enough to support this. And maybe it makes more sense to invest at the Series A or later once you know who the winner is going to be. So I don't know. It's a tough one. The nice thing about fintech being a little bit out of favor now is there are a lot fewer competitors to each of our companies now.
But it's kind of coming back, isn't it?
It is coming back, yeah, which is good and bad. I think so. It was super, super overhyped in 2021, where like everything we invested in, like somebody else would come in a few months later with a 3 to, in some case, in one crazy case, a 20x markup over where we invested in 4 months.
Wow. And not much had changed. Like I'm assuming the company maybe grew a little bit, but
yeah, but not like, certainly not worth an almost 20x markup.
And was it just like why? Do you know, if you had to go back and think about it, say like, do you know why there's so much hype in fintech around that time?
Yeah, I think low interest rate environment, some of these companies, I think some of the companies were like selling into other fintech companies, so it kind of builds upon itself. And just I think the ultimate belief is accurate, which is like there remains a lot of opportunities to improve the infrastructure of financial services. I think the low interest rate environment caused just people to put a lot of money into it. And so it was overhyped in 2021. And then 2022, 2023, like it was a severe overcorrection. And, you had public companies trading below their Series A price. And then what you've seen in 2024 is like those companies have done really well. And yeah, they were overhyped in 2021, but they were, if you invested in a basket of fintech companies in 22 and 2023, you've done really, really well. And the same is true in the private markets. Like I think we're seeing now investors, a lot of the generalist funds who are all in on fintech went out. Like if you could actually look at their like Twitter bios, people have said like, they said like fintech investor, that you see like they stopped being fintech investor on their Twitter bio. And then like now they're like reaching out to me being like, hey, what do you got in your portfolio? Like and I was like, I thought you told me like a year or 2 years ago that you were like all in on SaaS. And they're like, yeah, we're looking at fintech again, which is fine. Like it's totally a rational thing. It's just kind of funny.
Yeah, I mean, it's probably net good for you where it's easier for you to generate returns for your investors when there's less excitement for a space. As long as it's not too long. If we go a decade, no fintech, like none of your companies will raise follow-on rounds, which is, generally you're going to probably need to raise capital to keep building. But it's probably nice from like what's happening now from a follow-on perspective is you got some nice, very healthy entry points. And then other people are probably funding the follow-on, giving so you don't have to do it necessarily, and you can keep investing at lower prices earlier on.
Yeah, exactly. Actually, one of the companies that we invested in last year, led a seed round, is actually raising their Series A today, or announcing their Series A today. It's a $34 million round. So that kind of exciting Series A has not happened in our portfolio for a little while.
Sounds like it was like a weekly occurrence in 21.
Exactly. So we're back, baby. And it's interesting. I think it's easy to look at that and say, okay, we're overhyped. But actually, I think if you look at our companies that had raised at those crazy prices, actually a lot of them did grow into that valuation. So while that round in particular, like maybe should have been priced lower, like the companies did grow into that valuation. The next round for most of the cases was higher.
Yeah. And if you just look generally speaking at the quality of a financial services business or payments companies, like Visa is, I don't know where it ranks in like biggest companies in the world, but it's on the list. Like it's
one of the biggest companies in the world. It's an incredible business.
Yeah. Great margins. So kind of continuing the thread on Ryan and Flexport, when I asked him about this, he said you got to have him talk about his auction company that he used to run. So this is what you did after Fee Fighters, after or you got into angel investing. You did another company. Oh, what was it? Can you talk about it a little bit?
Okay, so the company was called Innovative Auctions, and it's a really fun story. It's like an economics business, auction business. So what happened was there's something called a TLD, top level domain. So obviously there's .com, there's .net, .gov, .org. These were kind of the original ones from 30, 40 years ago. And .com ended up becoming the standard. And .com is .commerce. This all came out of the Department of Commerce. And that's how it came out of like the US government Department of Commerce. And that's how it became .com. And that became the default because .gov was for the government, .net was for networking. And then .org came later. It was for nonprofits. And so .com became the standard. And it's kind of interesting. Like a lot of people who bought early .coms made a ton of money just investing in internet real estate in the 90s.
Yep. They're like the original NFTs.
Yeah. Yeah. It's a digital good. That's right. Yeah. And And then ICANN, which is the governing body of the Internet Corporation for Assigning Names and Numbers. It came out of the Department of Commerce, became an international intergovernmental organization, nonprofit. They are the ones who allow you to do new ones. So new ones. So the 2-letter codes, we can talk about that. Those are all countries, you may know. So like .vc is actually St. Vincent and the Grenadines. .ai is Anguilla. .co is Colombia. So people may or may not know that. But in 2012, 2013, ICANN said you can apply for your own whatever. And you have to pay $185,000 to apply. But if you apply and you're the only one who applies, and assuming you do all the paperwork right, you get it. But if multiple parties apply, then we have to figure out who's going to get it. So, Turner, if you could apply for a anything, what would you apply for?
Is this from like a personal, like a money
making? Because think about it. If you own .com, you're earning $10 per .com registration.
Oh, okay. So I want like a super, super common category. Man, I don't even know. Like, what are the most common websites? Probably like a store or something, or
that's a good way. So that's a really good way to think about it. What are the most common websites, or what are the most common domain endings already? And yeah, store and blog are 2 really good ones, and they're actually 2 of the highest price ones. So those are great ones. So let's just say .blog. So if you wanted to own .blog, you had to pay $185,000 to ICANN to apply for it. And then ICANN one day in 2013 revealed, sorry, Turner, you were not the only one that applied for .blog. Sheel and Ryan also applied for .blog. And then you had to figure out, okay, who's going to get .blog? ICANN said, why don't you guys figure it out amongst yourselves? And when two of you have withdrawn, the third one gets it. And in .blog, I think it wasn't like Sheel, Ryan, and Turner. It was like Google, Amazon, a billionaire who lives in the Cayman Islands, this venture-backed company that raised $150 million. And it was like these random hodgepodge of people, including like, multi-billion-dollar public companies. And so we went to these folks, and me and my co-founders. So one of my co-founders is actually a PhD in auction theory, and my other co-founder is a good friend of mine, Ulrich. So we went to these companies and said, how are you going to settle this? And we said, why don't we help you settle it with this transparent and fair auction? The way our auction worked is we do what's called a ascending clock auction. What that means is every X number of minutes, the price increases. And it's a second price auction, meaning you don't pay what you bid, you pay what the next person was willing to pay. And that's just like good auction theory.
Oh, really? Why is that good auction theory?
Because it means that you're willing to bid your highest bid. So like that's how eBay works if you think about it. Like you don't pay what you're willing to pay, you pay what the next highest person was willing to pay. And for that reason, you feel comfortable. Like let's say I'm bidding on this mug. I think this mug, I'm willing to pay $20 for this mug, but I don't necessarily want to bid $20 because I think I'm against you, and I think you're only going to be willing to bid $10. So I'm going to bid $10.01. But that's not optimal. What's optimal is if I bid $20, that way I win it, even if you bid $10.20. Like I would have lost it if I bid $10.01. I don't have to think about what your willingness to bid is. Okay, so let's use this auction of .blog, and it's me, you, and Ryan Peterson who are all bidding. So, okay, think about it this way, Turner. You can charge whatever you want, sort of, for .blog, and there might be a lot of registrations. There might be millions of blogs out there that might register for .blog. So what is your willingness to pay for .blog?
I make $10 per roughly.
You could make more, actually, in this case. So .com is heavily regulated what they can charge. For these new ones, it was less regulated. So you can charge a lot more if you want. And you can also do premium names. So like for .com, every .com charges the same amount. For .blog, you could create something like Turner.blog, and you could charge $1,000 for it, and you could charge $1,000 for the renewal for it. So there's all these premium names allowed now.
Interesting. So you could kind of like there's probably like some game theory almost and just like what you think you'll be able to charge for the domain over time.
It's really like a company, and you're valuing it sort of based on this like discounted cash flow of the future revenue for this company.
Interesting. I mean, I don't know. Like, I haven't really thought of this, like $1 million maybe for it, I guess.
So I think if I remember correctly, .blog sold in the tens of millions. But let's say your willingness to pay is $1 million. Because the way to think about it is like, let's say you sold it for $20 and you got 100,000 registrations. That's $2 million of revenue per year, and it probably increases over time. So, okay, so your willingness to pay is $1 million. Let's say that Ryan's willingness to pay is $6 million. My willingness to pay is $9 million. So the way the auction works is like every 20 minutes, the bidding goes up, and let's say you fall out at the 1 million, Ryan falls out at what I say, 6 million. So after 6 million, even though I was willing to pay 9 million, the bidding stops at 6 million, and I pay $6 million. But then there's a question: where does the money go? Like, who gets that $6 million? And that was the really interesting thing about our auction that we created, was we created a mechanism by which you could settle any dispute where people own something equally. So the 6 million gets equally split between you and Ryan when I buy the name for $6 million. So you, as a loser of the name, actually get $3 million for being the loser of the name. And it was a really cool idea. And if you think about it, it's a really fair way to split anything. So like if the three of us were in an equal joint venture on a business and ultimately only one of us could own it in the future, like that would be the right way to settle it. And so we created this idea and this mechanism to do it. And we ended up, we charged 4% for being the market maker here. So in this $6 million outcome, we would make $240,000 for bringing everyone together, for the software that we created, for the escrow service that we created. And it ended up being an awesome business for us that we ran for a few years. And ultimately, we settled over 150 of these auctions. And it was a cool little business that we ran for a couple of years.
And it started with domain?
It was principally for domains. And then we thought about other businesses that we could go after using the same technology and market making, which was like, we had this idea that we could do oil drilling rights in Mexico. The government had split up these rights into squares, and different companies had different rights, but they might be drilling into the same oil. So we had a bunch of other ideas. Ultimately, my co-founder ran with some of those ideas, and I ended up becoming a venture capitalist. So I sold the business, and my co-founder ended up running the business.
You sold him your portion of the business, you said?
We sort of sold the business, but he still runs the company from that acquirer.
Got it. Okay, that makes sense. And then from there, you're like, all right, I want to be a VC. I want to get into investing. How did you kind of first get into angel investing? Like, if I'm listening to this, I'm like, never invested in a startup before. Sounds interesting. How did you approach it?
Yeah. So I first, after the first exit from Fee Fighters, I had a little bit of money, and I had really enjoyed the process of like observing venture capitalists that we'd pitched back in the day.
That's a hot take. You enjoyed them?
Yeah, I enjoyed it. I thought I saw them and I was like, okay, in my mind, I was like, oh, those guys are the smart ones. They know everything. I'm just, I don't know what I'm doing, which I was true at the time. Still true. And they, and I was like, maybe I could do their job. And so I started doing some angel investing, found that I really liked it, and decided, okay, let me just help founders at the earliest stages. The other big change in my life was I had moved from Chicago to San Francisco in 2012 after we got acquired. So I was new to a city where like all this cool stuff was happening, and I had a little bit of money that I could start investing in companies. So I basically, me and my roommate at the time were like, let's meet a bunch of companies and give them small amounts of money. And and it ended up working out really well. And from there, I said, after the auction company had a lot more capital to invest, and I said, okay, what should I do here? So I actually started this podcast called The Pitch.
The rational first thing to do is just start a podcast.
So to be fair, this is in 2015. It's before the big wave of venture capitalist podcasts. Now there's so many of them, including great ones like The Peel. But I thought, so what happened was I was sick one day, or actually I was sick for like a week, and I was like sitting at home watching TV, and I was watching Shark Tank. And I was like, this is entertaining, but totally not real. What if I created the Shark Tank, but actually have like Silicon Valley style startups on it? So that was the impetus for The Pitch. And I was like, what if I just hit record on some of these folks that I'm meeting? And that was how we started in 2015. I found this guy, Josh Muccio, who had started some other podcast that was it was actually a podcast built on Product Hunt. He was like reviewing every product on Product Hunt. And I was like, oh, like he seems to know what he's doing, at least like has edited a nice podcast. So like I brought him on board, and then we started this podcast. And one of the first emails I sent was to Gimlet Media. They had this startup podcast, and I was like, oh, you should look at our podcast. And then like a year and a half later, they ended up emailing us saying, hey, we have been following your podcast. We think it would make a great addition to our team. And so they acquired our podcast to be part of the startup podcast. And then we had like a lot more resources. And then Gimlet got acquired by Spotify. And then we had even more resources. And then it wasn't doing that well for Spotify. So they killed it at the beginning of the pandemic.
Oh, wow. Okay. But wait, isn't it?
Josh bought it out from Spotify. And so he's running it again.
Okay, yeah, I was going to say, I definitely listened to an episode that was kind of recent. So
yeah, he's doing it again. He revived it, yeah.
What did you get out of the podcast? Like, was it beneficial? It sounds like you did it for a while.
I did it for a while. I think at the time I was an angel investor, like looking to build a brand in Silicon Valley. And if I'm honest, I think the problem with the podcast is like, people who are willing to be on a podcast for those sums of money are not always going to be great companies. We did have some great companies on there, companies that went on to be successful, but like the majority of companies would say no, or say like our round is happening so quickly, like I can't make time to be in a studio and like pitch you. So it ended up being a lot of, the listeners. We had a pretty good listener base, but it ended up being a lot of like entrepreneurs or folks who just like were not great founders in many cases. So it led to a lot of deal flow. I'm not sure it led to like really high quality deal flow. And then it did help me. It really helped me like build initial brand as an investor. And then now it's been so long. I don't think anybody thinks of me as like the Pitch podcast guy, but it was certainly like a while ago. It was part of my brand.
Yeah, that makes sense. It's something I've run into when doing this show is, like you try to get, somebody who's currently the hottest thing come in, talk about specifically what they're doing. It's like, if you've really got a secret that you're building around, do you want to go on and share it to the world? I mean, I guess the dirty secret is you see all these, founders that are well known. They're going on the podcast circuit. They're probably fundraising, or like there's a reason that they're out promoting, or they're trying to recruit people. Like they don't just come on and spill their guts and tell you everything. Sometimes people will. I think you got to be. I've tried to do my best at that. A lot of times it's like post ante or whatever. It's like I'll tell you all about the thing 10 years ago. Like we'll take you inside, tell you what really happened. So that can be helpful.
Those are super interesting, but it is a little bit of like, it's a lot less relevant. Like for the Mint, we have a lot of awesome people come and speak, like Ryan Peterson, Drew Houston, like Eric from Ramp, like a lot of like fantastic founders. But what I found is like a lot of their stories are awesome, but it was so long ago that it's not really as relevant as some of the best talks are by people who are like a Series B or Series C funded company who, they're telling a story of like 5 years ago or 4 years ago. And those are great.
Yeah. Well, speaking of the Mint, you just mentioned it. It's an accelerator that you guys run kind of inside of BTV. Can you talk about it real quick?
Yeah. So we call it our pre-seed program. And the idea is like when we started 500 FinTech, so 500 FinTech was an accelerator that I ran 2016 to 2018, ended up being super successful. So,
well, yeah, I guess so you joined 500.
I joined 500 and then I joined 500 startups and then I started like this FinTech accelerator.
Was this while you were doing the pitch? Like, were they like, hey, you seem pretty good, come work with us?
It didn't start because of the pitch. It was while I was doing the pitch though. It started because they had invested in Fee Fighters. And then they asked, I kept in touch with them and then they asked me to come on board. I said, sure, like I like helping companies at the earliest stages. I was investing my own capital anyway. They said, you can invest your own capital alongside us at 500 startups. So I said, sure, like let me invest my own money alongside the 500 startups. So what we would do is any company that I chose to invest in, we would split the deal where I would put up half the money and they would put up half the money. And then that grew into a fund and over the course, and then I ran this accelerator and we had 5 batches of the accelerator, during which we had 39 companies, of which 3 became unicorns and 1 more is a soonicorn, actually just raised around at a very close to unicorn price.
So do we want to say 4? Like, is that?
I don't. Let's just say 3. But I think it will ultimately be 4. So actually, like we had so if it's 3, that's like 7 point something percent. If it's 4, that's 10 point something percent. So like a pretty high percentage of these companies that we invested in at a $2.5 million valuation ended up becoming unicorns.
That's pretty good.
It's pretty good.
Yeah, for the people following at home, that's not an easy feat. The entry price or the number of unicorns.
Yeah. So I was like, okay, this is a tremendous amount of work, but clearly we're onto something. And by the way, like we still so many years later, I'm super close to each of those founders. And actually all of those unicorn founders are LPs in our fund now. But so I was like, okay, this accelerator thing, people think it's a bad idea, but I have all this data. Like I've done it before and I've seen the power of it.
So what is the thinking that it doesn't work? Like if
I think a lot of LPs have told us accelerators don't work, other than YC.
Yeah, why don't they work?
I think there is real concern about an adverse selection risk. Why would somebody go to your accelerator over YC? And I think that is very true of a generalist accelerator, but it's not true of a specialist accelerator. And so what we realized and what's true of our companies now in the Mint is the vast majority of them were not looking for accelerator. It's really like we led their pre-seed round and we led their pre-seed round through this program that we have standardized. And so our program is we invest $500K for 10% and they get to work with us very closely for 3 months. Like we work in the same office. We bring in a bunch of experts in design, tech, and go to market. And then we spend a lot of time with the companies, help them raise their round if they want to raise the round and all that kind of stuff. And it's gone really well. I think it's going, from what I can tell, it's going better than the equivalent time in my 500 startups days. So like at that time, 7% of the companies ended up becoming unicorns. I expect it to be similar in this new batch of companies. And we get it. It's really fun for us. Like we get to work really closely with these companies. We have a different relationship with them than anyone else because like they work out of our office and it's just like a real camaraderie situation that we have with them. So we were excited to start it. And actually, when we started BTV, we knew that some sort of accelerator type program would be a part of what we did. And then the pandemic hit, so we weren't able to do it. And then we finally did it in 2023. And so we're 3 batches in. We choose 6 to 8 companies per batch. And we've done 3 batches in San Francisco. We're doing the next cohort in New York, and it starts in March. And that's a pretty exciting one. You know, we love San Francisco and the ecosystem here, but for fintech, New York actually outpaces San Francisco in early stage fintech funding. And we have a lot of companies in New York. We actually have more companies in New York than we do in San Francisco. So we said, okay, like we should do the accelerator. We should do a cohort in New York. And we have actually half of our investing team is also in New York. And I'm going to move to New York to run this accelerator. So yeah, it's going to be great. So we start in March, and we're looking for 6 to 8 companies to work really closely with, and expect that one of those companies is going to become a unicorn, which is pretty exciting to think about.
Yeah, that's awesome. And I think generally when I come across an accelerator, my general thinking is like, I don't know about this. I think I've gone to every single one of the Mint demo days, and every founder, like every pitch, I'm like, oh, it's actually a pretty good idea. Like it seems like a pretty good founder. That's generally not my takeaway for the accelerators. Like I feel like it's very, very high quality. So I've always been a fan.
And actually, so yeah, you asked a little bit about like the differences with YC.
Well, I remember, yeah, we were in it. We were in one of the group chats that we're in. There was like some debate back and forth of like could you actually still make an accelerator? Like, so how did you guys think about just designing this whole thing?
So I was really lucky that I had the experience from 500 startups. So I knew what they did right, what they did wrong. For me, one of the things I really wanted to do was have it be in person. So we have a dedicated space where founders come and work from. And what that does is it helps them get really close to us. So like anything that's like real time, like I've got a customer, I need to send them a contract. They just like tap me on the shoulder and like we can just chat about it and whiteboard. And first of all, like I love doing that. I think it ends up being super helpful. And so many years later, actually, like it happens all the time where somebody in one of these like now unicorn companies will, like when I'm meeting up with them, they'll tell me like, I remember this from the time that we talked about X topic in 2016. And I'm like, man, I have no recollection of that. I'm really happy that you took what I said seriously, but I don't even know if I knew what I was talking about. But no, I mean, I think that sort of stuff ends up being super helpful. And then they end up learning from each other so much. And it ends up, actually, we've had companies from the early days of our accelerator acquire other companies in their cohort. Like we have one of the unicorns ended up acquiring one of the other companies in the same cohort, and it was a company that they like sat across from while they were in the accelerator.
Yeah, so it wasn't like it's like a shotgun acquisition. It was like, oh, we've known each other for like 5 years. Like we'll just come work here.
Yeah, exactly. And then, so one interesting thing is like most of our founders actually did not apply to YC. So it's not like we're competing with YC in that way. They were looking for early stage funding and liked the idea of working with people who had been founders before, run successful companies, and are specialists in fintech. And they thought, okay, like we can shortcut our time to market. We can learn from experts. We can get a bunch of resources. Like one of the things I talked about was a bank partnership. Like one of our companies in this most recent cohort, they were having trouble getting a bank partnership. And then after working with us, a bank said, yeah, like if you're a BTV company, we will work with you. And that was that was a huge unlock that like, it's possible they wouldn't have been able to get it at all if they weren't working with us. So that has worked really well. And so we have these fintech companies, and most of them, like I said, we're not looking for an accelerator. Actually, Paul Graham and I had some chatter about this, and he looked in the data. And so our companies, the ones that became unicorns, so let's say the 4, like the 3 unicorns plus the 4th unicorn, of those, actually only one of them had also applied to YC.
Oh, wow.
So it's not really like we're competing with YC. I think they're great at what they do. We just have something that's totally different. And we think about it as our pre-seed program. And as an advantage of us leading your pre-seed round, you get to participate in this program.
Yeah, it kind of sounds like you've wrapped the value add, bullshit that everyone talks about, just like into this, like, instead of just like, oh, I'll connect you with the other founders in the portfolio, it's like, no, like you will get connected, you will sit with them, like you'll meet them. And like maybe it's like a more organic, more fleshed out, thoughtful version of the like, here's all the things we can do with just everyone just comes and works together and it's just there.
And so we're like really big believers of the benefits of our portfolio spending time with each other. So the other thing we do is we have a camp every year, which is like a few days. We go into Santa Cruz Mountains, and there's a lot of like team building stuff, but then there's also, so it's like a lot of fun. And then there's also work stuff. Like we have coaches talking about co-founder conflict. We have go-to-market experts, head of talent type of folks there. But the best thing that comes out of it is our companies end up working together so closely, which I really like. And they learn from each other. Like they share knowledge. And I think it's particularly valuable for our portfolio because we're fintech focused. Like so many learnings from one company apply to other companies in our portfolio.
Yeah, it seems like I think part of the, going back to that group chat discussion, I think it was the takeaway, my takeaway from it was the verticalized accelerators can work because there's maybe more like synthesis and learnings. And like, you're not going to compete with YC and like the biggest top of funnel, the biggest network, but you actually might have a bigger network in fintech than YC does. So it actually might be beneficial. And to your point, I guess like you have obviously convinced some people that it's worth doing that wouldn't have done it otherwise. So
yeah, it's been great. So we do it twice a year. Like I said, 6 to 8 companies. And I think we're going to do one cohort in New York, one cohort San Francisco, but we'll see how it ends up. Just trying this one cohort in New York now.
Okay. Yeah. I mean, it seems like it'll probably work if
I think it's going to be awesome.
And speaking of what you mentioned, Jake, your co-founder of BTV, he also started a fintech company. How did you guys kind of get to start knowing each other?
Yeah. So the company he started was NerdWallet. It's now a public company. I've been a fan of NerdWallet from afar for a very long time. Actually, one interesting tidbit is there was a newspaper article, some media article that mentioned both me and Jake back in 2010, way before we knew each other, because our company, Fee Fighters, had a lot of similarities to NerdWallet. And
you were probably like the B2B version, like the corporate version of.
That's exactly right. So like while they helped you get a credit card for consumers, we helped the merchants get credit card processing. So, and there were some big changes in the world, like the Durbin Amendment, which we don't have to go into now, but in 2010, and there was an article that actually referenced both of us, co-founders of whatever various companies. So I knew of NerdWallet and had been an admirer, and their story is kind of interesting. They didn't raise any venture capital money to start with, and then they did they only ever did one round of funding.
Because it's basically affiliate fees is how they make money, which is like no VC is interested in that, right?
Yeah, that's what they thought. And then they were like, they never needed the money. Like they were, you know, basically putting their own savings into it, I think for a year and a half. And it was just Jake and Tim. And then a couple things started to go right. And basically Google had to change in their algorithm. And it's a really fun conversation, but Google had to change in their algorithm. They started making a bunch of money, and then they started hiring a team, and then they didn't need any money. They were able to grow organically. And then I think they only did one round of funding, and I think it was $64 million. They're like, call it Series A round, but they already had a ton of revenue.
That's almost like a Series A today, or maybe it's like a 2021 Series A.
Yeah, today. Wild. And it went well. And Jake at some point had been wearing all these different hats of the company, and he said, we need to professionalize, hired a bunch of people to replace him, and went off and was doing a bunch of angel investing his own capital, and then investing for some others as well. And I met him in 2016 when I was running 500 FinTech, and I said, hey, why don't you join me for a bit? And so he originally came on like part-time, 1 day a week, and then it became more and more, and he became my de facto partner in the fund, where he would helped me raise the fund, he helped me deploy the fund. And then in 2019, we were both being recruited by other like multi-stage funds to be a fintech GP. And at some point we looked at each other and said, I think it might make sense for us to do something on our own. I think we're too entrepreneurial to go into somebody else's fund. Let's just do our own thing. We felt like there was a gap in the market. What we really wanted to do was seed and help companies at the earliest stages. And so we started BTD.
And then, so what was the gap in the market? It was just early stage, like first check.
Yeah. So what we found was at 500 FinTech, we would give them 150K, and that wasn't really enough money. And then we'd spend a ton of cycles helping them raise more money. And it ended up being like, what we wanted to help them do was like build their business. And instead, what we ended up helping them do was like raise more money. And there were not other investors who were like lead investors focused on FinTech who we could send people to. Not many investors had at the seed stage had a founder background or like the right kind of background who wanted to step up and lead rounds. So we said, okay, like we can fill this gap in the market by leading rounds of FinTech companies. We can control, like how much money we invest, get the right ownership, and build a solid franchise in FinTech.
And so if I'm listening to this, I'm like, oh, I'm thinking about starting my first fund, getting a fund one. Like, how do you actually raise a fund one? Like, what was the real process?
It took forever. So the first, there's like what we call Fund Zero, which is 500 FinTech. That was really hard.
And these were, you would raise from, did you raise individual funds?
Yeah. So 500 FinTech was a specific fund. It actually wasn't that tied to 500 startups. Like we got no money from 500 startups for 500 FinTech. So 500 FinTech, I raised it myself. But when I started, I just started investing and I was putting my own money into the fund. And so I put a lot of my own money into the fund to get started. And I was basically pretending like I had a fund for the first 18 months with my own money. And I was like, yeah, we're investing from 500 FinTech. Little did they know that 500 FinTech was Sheel Mohnot's bank account, putting money to a 500 FinTech entity that would then send money to you.
So it was like inefficient because it was like there's probably like fees and like legal like complications of.
Yeah, it was inefficient, but it was what I had to do to get started. So I did that, and then ultimately, was able to raise the fund, thankfully, or maybe not thankfully, because maybe if it had been my own money, like that fund ended up being a banger. And if it had been my own money all the while, that would have been pretty sweet.
Yeah. Who do you usually find for like the first wave of LPs when you're just like, there's maybe not quite enough proof points or track record yet? Like, what do you recommend for people?
So we ended up going after, so at that point I had met enough people in the world of FinTech where I was like going after some FinTech founders who had success. And so some of those folks ended up coming in, founders of some very successful companies. And then I just went through the world of FinTech, kind of pitching everyone I knew. And so it ended up being a lot of like friends for that early capital. And then using that, I was able to say, hey, look, all these successful people investing in this fund. And then I went to some like fund of funds and got a little bit of fund of funds capital in that first fund. And in the second fund, which is BTV1, the first BTV fund, we started out with all those investors, the individuals who were in BTV 0, 500 FinTech. And then, at that point, we had a better story for institutional investors, which was we're leading rounds, which is what a lot of fund of funds want to see.
Why is that so important? Like, why is leading a big deal?
So they want to see big ownership, because if you think about what a fund of funds does, they are spreading risk. They're picking a bunch of managers and investing a small amount. They're owning a small amount of every manager to get access to ultimate end companies. And they want to own some portion of that end company. And so by investing in us, like if they might own 1% of some great company, and that will be awesome for them.
So they have 10% of your fund, and then your fund owns 10% of a company. So they own effectively 1% of this awesome company that you bought super early.
But if we only own 2%, then they only own 0.2%. And then it's kind of like, oh, we have some exposure, but it's not really that much.
Yeah. I've actually heard people describe it as, if some fund of funds, they look for managers who their individual, like an individual portfolio company can not only return the fund, but return to the fund of fund also. So like that's that's hard to do.
It's really hard to do, but it happens. Those are like, call it generational companies definitely do that, which is amazing.
So it's basically low entry point, high ownership to the point where, you come in at 5 million posts, 10 million posts, the company exits for $20 billion and you owned 8% of it at exit. And, it was whatever percentage of the fund, which was whatever percentage of the fund to fund. So it's like, they had a $200 million fund to fund and your, position return $200 million to the fund to fund.
Yeah, exactly. And actually, I like, there have been a bunch of these. I saw like Service Titan just IPO'd. I know that was in Mucker Capital. And I think it was part of their accelerator, the Mucker Lab.
Oh, so that was like single digit entry point valuation. Yeah.
I think very low single digit entry point. They also had Honey, which was like a $4 billion exit. So they've had, that was their accelerator that was like, everybody was saying, okay, you're only getting the rejects from YC. Meanwhile, they've had like these huge outcomes. And I think you're going to see that from others, including us, hopefully.
Any other advice that you find yourself giving people often when they're raising their first fund?
Yeah. Another is like, if you find a institutional investor, I would say like, just have other folks that trust you. So like your co-investors, just have them send a note. And I do this all the time for folks that we've co-invested with. If they're meeting with one of our LPs, I will proactively send them a note saying like, I've worked with so-and-so on this deal. They're on the board. They're an awesome board member. I love working with them. I would personally invest my own money. Like, I would tell anybody to take money from Banana Capital.
Wait, are you making this up or is this actually a reference?
Actually, true. People have asked me about you, but like you could use me for something like that if you're pitching somebody and, we're friends. I'm an investor in your fund. We've co-invested. I could say like, I've seen the value that Turner adds. And like that opens up a conversation I can have with that LP, and that can be super helpful to you when you're raising.
So does this happen often? Like, I mean, I know that it does, but like how often does this happen where, they're going to go to all the co-investors, try to get the reference check? Like, what's the extent of all this, do you think?
It happens all the time. So like, I would say every couple of weeks, an LP is hitting me up for a reference on another investor.
Interesting. And then what do you think, how do you set yourself up to be successful with those references, like as the GP raising?
Yeah, so I think for us, references were huge. Like we were somewhat, the LPs didn't really know us. So they did a ton of references. I think, so one of our LPs did 30 references in our portfolio on us. And they actually said like, they weren't like going into it, they weren't sure about us because they hadn't historically done sector specific funds. And then they were like, they started doing the work and then they just kept doing more and more work. And I in my mind, I was like, did you really learn anything in the 15th through 30th call that you did? Like, that sounds like a lot of time to spend referencing one fund, but they did it. And then they ended up coming in and they actually like, they said it was some of the best founder references they've ever received. And so that was super, super helpful for us. They said like, it was like, they've referenced hundreds of funds and they said it was top 3 founder references they've ever received.
Wow. That's a big seal of approval.
Yeah, it was amazing for us to hear. And also it's cool, like even areas like we asked like where can we improve? And we actually got some areas where we can improve, like in how we help founders connect with each other, some stuff like that. And they shared their notes with other LPs. So other LPs felt like they didn't have to do as much referencing because this fund that they like and respect did 30 references and shared their notes. So they were like, okay, like we don't have to do our own 30 references and spend a bunch of time with founders. And that's great because like we hate it when founders, like we hate taking any founder's time away from building their companies. So that was super helpful and something I'd really recommend.
Yeah. Okay. That makes sense. And then when it came to fund 2, I know so your first fund was at 75 million?
Yeah. BTV 1 was 75 million. So 500 FinTech was 15 million. BTV 1 was 75 million. BTV 2, we doubled in size. It was 150 million.
And fund 1, did you do 19? Was kind of 19 when you raised it ish?
Yeah. So we raised it at the end of 2019. So our first check was, I think, the end of December 2019. So really, It was like a 2020 fund. Our first check was actually Unit, which I know you've had Itai on here.
That was a good first check.
Yeah, it was an awesome first check. It went from, we led to seed at 12.5 million posts, and they 2.5 years later they raised at a $1.2 billion valuation. So it was a good one for us.
And they've grown in.
They've grown
a decent amount into that. Yeah, that's awesome. And then Fund 2, you raised in the end of 21, beginning of 22. I'm trying to remember.
December 2021.
Oh man, so it was like the most liquid moments of the market, right?
It was a very fortunate and lucky time to raise. So we had our LP meeting in October, and we told LPs we're going to raise in Q1. And at that time, we felt like LPs were like, okay, like we're ready to sign. Like we're ready. And some LPs who had written us like a $1 million check in Fund 1 were like, we're going to do 10 in Fund 2. We're like, oh shit. All right, well, let's come up with some documents that you can sign so we don't lose this momentum. And so we came up with these documents, and then we raised Fund 2 really quickly. And that was awesome. Obviously, it's nice to have the validation that you can raise a fund really quickly. There's also a moment in time in which, the LPs weren't doing as much diligence as they're doing now, for better or for worse. And that goes both ways, is one thing I've learned. Like we raise a lot of money very quickly. And I think at that time, if we wanted to raise like twice the size of fund, we probably could have. What I realized is like some of those, because it happened so quickly, it ended up not being the folks that if we had like done our homework on them, we would have taken. And nothing bad. It's just like we ended up getting some new fund of funds in there who then struggled to raise their follow-on fund. So then like can't come into our new fund, versus if we had done more endowments who wanted to invest, but just have take longer to like, they have an investment committee and all this other stuff, that would have been a better long-term partner, which now we're doing. Like we're raising Fund 3 and we're setting ourselves up for success with more long-term committed capital.
Yeah, I got hit by that with my Fund 2 that I closed in the first close the middle of 22, whereas I called them cotton candy commitments, where is people who told me they were in, and then when I did the close, which I probably didn't do fast enough. That was my big learning. Is I should have just, it was, people commit in like February of 22, the end of 21. I should have just had them sign. And then when I tried to do it the summer of 22, it was a lot of those types. It was like fund to funds I had to raise, a couple crossover funds that had told me they were in that stopped doing fund investing. So then one thing you've mentioned though is the importance of being able to follow on. It sounds like you increased the fund size, you're able to follow on a little bit more. Like, how do you think about following on, and is it important?
Yeah, following on is super important. We lead almost every one of the companies that we invest in, not everyone, but for the vast majority. And so I think people expect the lead investor to follow on, but we don't always do it. So, we've had a lot of difficult conversations about not following on into a company. And, one thing that's been great is in every case that we didn't follow on, we ended up having a great relationship with the founder. Maybe immediately it was a really tough pill to swallow for founders, but over time they said like, oh, wow, that you were upfront and honest with us about how you thought the business was going. And you helped us, even though you didn't follow on with your capital, you followed on with your time. And like they said that they appreciated that. And it ended up, in some cases, we told them like, look, you're a very talented person. Maybe you should be doing something different with your time. It's okay. Like, don't return the money to us. Like some of our hypotheses when we started this business, like just didn't play out the way we had hoped. And that's okay. So we don't always follow on. In many cases we do. Our fund is set up with a 1-to-1 reserve ratio. So for every first check we write, we have, for every dollar we write, we have another dollar that's available to follow on. So what that means is we concentrate capital into maybe our top 20% of investments and follow on heavier into the Series A, and in some cases into the Series B.
Does that hurt returns though? Like, shouldn't you just invest more early on?
Yeah, it's a great question, and it's really hard to have the counterfactual. The reason for that is, so as a lead investor, would you be able to be a lead investor if you didn't follow on into deals? Maybe not. Maybe people would say, oh, this guy doesn't follow on, like I'm not going to take their money at the lead. So we don't actually have the right data to tell us what makes sense. We think so for us so far, if you look if I look at my 500 fintech data, if I look at the companies I followed on into, I should have gone heavier in follow-ons actually.
Really? Okay. Well, I think that's definitely something. It's like the very best Series A's companies, like the very best Series A's, like they're probably 100x, right? Like, should you have done Stripe's Series A or should you have done a new random, pre-seed or seed? Like I don't know, probably you should have probably just invested more in Stripe or Anduril or Ramp, whatever.
So this is an outliers business, right? And so like concentrating your capital into your winners just really makes sense.
Yeah. I think also being able to follow on, like I have a couple of portfolio companies, where they had shitty times raising like a follow-on round and then they raised like a really good Series A or whatever. So it's like you get another chance to invest a little bit more at a good price in the good companies before other people realize it's obvious. I think that's another place it might make sense too.
Yeah, absolutely.
Yeah, where can people find you, by the way? I think we'll throw some links in the show notes, but we've got like the Mint, we've got the BTV website, you're big on Twitter.
Yeah, I think any of those three are probably good. My Twitter is at pitdesi, PITDESI, btv.vc, themint.vc are our websites. Easy to find.
Amazing. Well, this is a lot of fun. Thanks for taking the time to chat.
Thanks, Turner. I feel like we could have chatted like another hour if we had to.
Maybe round 2 at some point.
I'm super down. It's fun.
And thank you for listening. If you like this episode, please leave a quick review or comment wherever you're listening or watching. Make sure to check the show notes for more on the topics mentioned throughout the conversation. And if you don't want to miss a future episode, subscribe to my newsletter, The Split, to get each episode plus the transcript emailed directly to your inbox every week. Thanks again for listening. See you in the next episode.
Hey everyone, Eric here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at ericaturpentine.co. That's ERIK at turpentine.co, and let's partner together.